The chance of recession is dropping, but remains elevated. There's continued noise, some might say a bit of chaos in Washington, D.C. that's making investors nervous or excited around tariff policy, inflation, and interest rates. Stocks are bouncing back to more stretched valuations as tariff talk softens and investors started to believe that tariff damage might be smaller than expected. Bonds were solid, but downgraded by rating agencies. That plus a general retirement planning review, video option, and more in this quarter's quarterly context webinar for WealthStep. Watch to stay relaxed by staying informed and remain current about the things that actually matter towards staying focused on your long-term goals and retirement readiness. As always, we hope you'll walk away from this review with an eye towards aim, save, and invest with some of the broader quarterly context topics that might help you focus on these three key areas by staying generally abreast of what's going on out there separately. The part one is this video with focus on topics for context and education around information that helps make better long-term decisions around by being more familiar with markets, economy, and investor behavior. And then there's a separate short, quick video overview of key retirement readiness steps. And there will be also hinting there at the full video on WealthStep.com should you like a more complete review. As always, we encourage people to focus on the things that matter and that you can control, that space in between. You can't control markets. You can control your discipline in staying focused on saving and being a disciplined investor, investing appropriately for your life stage and sticking with it through bumpy markets. There's always news that can move markets a little bit in the long run. Those bumps tend to iron themselves out. The big themes in the second quarter of 2025 related to the tariff talk, a pretty fast and furious set of tariff rollouts and rollbacks. And in the end, as it became clear that the tariffs might be partly a negotiation tactic and might not all stick, at least at those initial levels, the market had some material bounce back after what was a pretty bumpy first part of the quarter. Here you can see as well as the tariff, what the market did as tariff came on. When the big tariff news came out, the market dropped pretty steeply for a little bit, then tariffs cooled and the market went back up, tariffs were back on or increased and market was back down. And then as that became clearer that some of the bigger tariffs were going to stay off or be reduced, then the market went for a run. Overall, interest rates at the Fed stayed at the same level, just above 4% after several hikes last year, cuts last year, and a bunch of hikes in the year or so, or three before that. Overall, inflation is hovering in a much more tame level than it was just a couple of years ago when it was at 9%. The Fed wants to see those inflation numbers down closer to 2% before it cuts rates again. And there's been tension around that in Washington as well, with some risk that the president may try to replace the Federal Reserve Chairman in hopes that rates might be cut sooner. Overall, as mentioned, markets were strong. The stock market was up about 11%. The bond market was up just over 1%. Unemployment hovering around the same level at 1%. And the economy actually shrank a little bit in the second quarter, down about 0.5%, lower than the 3 and 2.5% rates that we're showing in other recent quarters. So some of the economic momentum is slowing. However, no clear pattern that would suggest a recession yet. However, there is some probability or possibility of that still. You can see overall markets, again, US, international, emerging market stocks, quite strong for the quarter. That's more than what a normal full year return might look like. Bonds were lower, as you would expect in general, but also positive. Now, for the first time in a while, there's only one down arrow or negative return across all of these different time periods, and that's bonds for the 5-year number, but this number is shrinking as bonds are continuing their gradual recovery as rates have come down, but are now hovering around that 4% level, 4% Fed level. Speaking of rates, bumpy pattern over the years. Generally, rates are brought down to stimulate the economy as the global financial crisis brought down near zero, hovered there for quite a while, ratcheted up to create some dry powder for the next recession, and then COVID happened, rates were brought back down, and then the Fed had to bring rates up farther to try and rein in the inflation that was partly the result of this stimulus. This type of stimulus helped prevent a Great Depression, but then it triggered inflation, and that is a much preferable situation to have some inflation, even if that's not comfortable for everyone and not a great situation. But higher inflation is better than a Great Depression. Depressions take a lot longer and are a lot more painful economically and hurt a lot more people for longer, typically. The Fed expects and the market expects rates to come down, but it's not clear when exactly that would happen. Some talk about having another cut or two before the end of the year, but it will depend on what happens with the economy. Overall, the chance of recession, according to some economists, has gone down relative to the prior quarter, which was closer to a 60% chance. Now it's reversed, a 60% chance of not having a recession and a 40% chance of recession. But 40% is still significant. That's almost a 50-50 chance of some sort of more significant cooling. However, oftentimes markets experience a full recovery before the recession is over, and recessions are defined looking backwards based on certain data that doesn't come out until later. So sometimes if it's a mild recession, it might be called a recession, and before people really know that it's happening or it's over. Quick view as a reminder, different parts of an investment portfolio will do better at different times. That's where the benefit of diversification comes from. When one asset class is down, another might be up. And asset class performance is cyclical. So we can see here, this shows the how much higher or the multiple of price that large company stocks are relative to small companies. So when this line is elevated, it means that large companies have prices that have expanded or increased faster and more than small companies. And usually after that's been the case for a while, there's a reversal, as you can see back here in time. So we're approaching this kind of high level. That doesn't mean there will be a reversal at any specific time, but it's a reminder that when something is in favor, it tends to go out of favor over time, and when something is out of favor, it tends to go into favor. So if you have a portfolio that is well built, highly diversified, you should expect that things will be out of favor sometimes, and then expect that those things will bounce back. It's just not possible to predict when. As a reminder as well, with rates being relatively elevated, money market funds, and for that matter, even CDs, although they're less liquid and have penalties sometimes, are paying considerably higher rates than they were a few years ago. So if you have a significant amount in savings or checking that you're not going to be using anytime soon, but you still want some principal protection and really don't want any volatility, if it's money you're going to be spending in the relatively near term, then consider moving that money into a money market fund somewhere and earn closer to 4% rather than what's probably 0% or very close to it in a typical bank account. Then this video around general financial and retirement readiness will be in a separate link provided in this blog post where you might have found this video, and then the full education video is shown at the address here. And we thank you for joining today.